Welcome to the Apprentice Trading Library. In this segment, we will explore the connection between interest rates and stock prices. Interest rates play a significant role in influencing stock prices, although the relationship isn't always straightforward and can be nuanced depending on various factors. Here's a breakdown of the key points. Generally, rising interest rates tend to put downward pressure on stock prices, while falling interest rates tend to have the opposite effect. Here's a look at why. Discounting future cash flows as one reason why interest rates put pressure on stock prices. Investors use present value calculations to determine the worth of a company's future earnings. Higher interest rates make future cash flows less valuable today, leading to lower stock prices. Alternative investments are another reason interest rates put pressure on stock prices. When interest rates rise, investors have more attractive options like bonds, which offer guaranteed returns. This can draw money away from the stock market, reducing demand and pushing prices down. Company borrowing costs also contribute to interest rates, putting pressure on stock prices. Higher interest rates increase borrowing costs for companies, impacting their profitability and future growth potential, which can negatively affect stock prices. And finally, economic growth. Rising interest rates are often implemented to curb inflation and cool down an overheated economy. This economic slowdown can impact corporate earnings and investor sentiment, leading to lower stock prices. However, it's important to remember that the impact of interest rates on stock prices is not always immediate or linear. Several other factors like company performance, industry trends, and investor sentiment also play a role. Different sectors react differently to interest rate changes. For example, growth stocks, which rely heavily on future earnings, tend to be more sensitive to rising rates, while value stocks, with more established earnings, might be less impacted. Interest rate changes can have both positive and negative effects. Lower interest rates can boost stock prices by making them more attractive compared to bonds, but they can also lead to inflation and economic bubbles in the long run. Here are some additional points to consider. The Federal Reserve's monetary policy plays a crucial role in influencing interest rates. Investors will closely follow Fed announcements and their impact on market expectations. The global economic environment also plays a role. Global interest rates, inflation levels, and economic growth can all influence domestic stock prices. So, understanding the relationship between interest rates and stock prices is crucial for informed investment decisions. While higher rates generally put downward pressure on stock prices, the impact is complex and depends on various factors. Always consider other market dynamics, company fundamentals, and your risk tolerance before making any investment decisions. I hope this explanation has been helpful. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more